Welcome back to my channel. The last 2 months have been quite scary. If you follow the stock market, we've had some really scary days. There was one day when the NASDAQ dropped 12%. Overall, the volatility has been off the charts. And I don't think it's going to change anytime soon. We still have a big tariff war with China going on. We have an impending recession upon us and we're not quite sure what interest rates are going to do. Inflation seems to be going down, which is a bit of good news. So, as a stock investor, how are we supposed to manage our portfolios? And in order to accomplish a couple of things, one is to grow our wealth, to grow our net worth. That's definitely on the table. But the other is to be there when we need it. And the answer to that question depends on your age. What life events do you have coming up? Are you going to retire in the next year? Are you going to maybe buy a house and need a big down payment? Are you going to start a business and need capital to put into that business? So you got to work around those life events and have the capital there when you need it. Now, if you're going to need a pretty substantial amount of capital, let's say in the next 5 years, the stock market may surprise you to the downside in the next 5 years, and you may lose quite a bit. The stock market is an investment where you need to stay in for the long haul. It's not something where you can precisely predict, hey, this is how much I'm going to have in a year or 2 years. You may have much more, or you may have less than what you intended to have. For that reason, there's asset classes that can preserve wealth, that could keep an investment at around the same value as it is today. Maybe go up a little bit, maybe drop a little bit, but not too much. And in the meantime, likely provide a yield in income. So that's what this video is going to be about. It's about preserving wealth and the amount of your portfolio that you would want to preserve and make sure, for example, I'm going to have that portion of my portfolio over the next 5 years. It may be a little bit more or a little bit less, but I need that money. I need that capital. So I'm going to preserve that portion of my portfolio. For an older investor, that might be 50% of a portfolio because that person might be 60, 70 years old and they're retired and they want to stay retired and they maybe want to travel. So they don't want to take all their portfolio and put it into stocks because if we have the year we're having, you would be potentially at a 15, 20% loss. And it'd be hard to take that across all your portfolio. But if you have a portion that really pretty much kind of covers everything you need for the next 5 years or 10 years, then you can continue to be a stock investor and not take on too much risk of having to change your lifestyle. I think it reduces investing, it reduces the emotions of investing. Because if I put a portion of my portfolio to cover, in my case, what I like to do is cover the next 5 years of living expenses. My lifestyle is not going to change. Stock market can keep crashing. I have the next 5 years covered. Therefore, there's really less to lose. I'm just going to keep investing in the companies I believe in. My investing philosophy and strategy remains intact. There's no force to prevent me from executing on that plan or taking on new opportunities in stocks. So we're going to talk about preserving wealth, and I'm going to provide a few examples of where investors can preserve wealth and what that particular asset class does for an investor. Again, the percentage of your portfolio, that's your decision. How much you're going to put there, that's your decision based on age, how much risk tolerance you have, and if you have life events coming up that you need to work around and make sure that you have a particular amount ready when you are either going to buy a house or maybe send somebody off to college, maybe start a retirement and so forth. So let's go over the different asset classes to preserve wealth. The first asset class is a money market account, otherwise referred to as cash. And it's been quite productive to be in cash over the last couple of years because the yields on short-term money market accounts have been very good, considering that you really have almost no risk of your investment, your principal going down in value. But for the 1 year, In the case of the money market account that I'm showing, you would have had a yield of 4.65. Well, 4.65, a positive 4.65 looks pretty darn good when the S&P is down about 10%. You're outperforming the market by like 14% if you're just at a positive 4%. And that's part of the point that I'm making is right now these investments show up really tall because stocks have really gotten beat up. Crypto is down. So the higher risk investments are really losing value in 2025. And nobody could say if that's going to stop. Are we going to lose another 10% or 20%? It's very conceivable. As recently as 2022, the NASDAQ lost 35%. And right now, the NASDAQ is losing about 15%. So we can go down a ways from here, maybe another 20% to the downside. So cash is the first easiest way of allocating a portion of your portfolio. Now, food for thought. Currently, money market accounts are paying a really high rate of return. But over time, this could really go down. If you look at where money market accounts were 3 years ago, when interest rates were far lower, you were lucky to get a 1% return. Maybe even 0.5% would have been achievable. But right now, conditions are where, hey, you can do quite well in cash. No big surprise, the great Warren Buffett has a big portion of his portfolio in what people generally classify as cash. So, very good option at the current time. Just as we go through, maybe in a couple of years, keep your eye on interest rates because this may not be this good for a long time. We may not need to readdress this asset class should interest rates really fall. The next asset class is bonds. And bonds you could purchase either through an ETF or individual bonds. ETFs make it really easy where buying individual bonds is more difficult and there's more loose ends to tie there and there's more to manage. If you haven't invested in individual bonds extensively and have a lot of knowledge, working knowledge, I would really encourage you to think about ETFs. They make investing in bonds far easier, lower risk, and more liquid. You can get in and get out very easily. Whereas individual bonds, it's a little harder to get in and it's a lot harder to get out. So if you buy an individual bond, typically you should be ready to own that bond for the duration of that bond term. So let's go over a couple of ideas for ETFs and what they can provide for you. When you buy bonds, you're buying a couple of things. One is the yield, which we most definitely want to keep our eye on. And the second is term. Term being, am I going to, when you make a bond, you're making a loan either to a government or to a company. How long do I want to loan my money? For 6 months, for 5 years, for 10 years, right? And that term will affect the yield and the flexibility of the investors being able to cash in that investment. Now, a short-term ETF, like the one I'm showing, the Vanguard short-term bond ETF, this is a low expense ETF. It pays a nice dividend of 3.53%. It's very good. And it has little risk for the price to fall because the term is shorter. The shorter the term, the less we have risk, and it's referred to as term risk. If you have a long-term bond and interest rates were to move up, that bond would lose value. If interest rates go down, a long-term bond would gain value. So those types of things and those swings would not affect short-term bonds as much, but it would affect long-term bonds. Right now, this provides nice income at 3.5%. It preserves the value of that particular investment. For example, for the past year, this ETF has gone up 2.44% in value. And that's not a bad return right now. Again, stock market's really down. And investors were also paid 3.53%. So if we add those two together, we're up to 6% overall return, which is fabulous in 2025, if I may say so. So here's an example of a short-term ETF, a short-term bond ETF that I'm invested in and really like having. Now, let me show you a couple more options. This particular ETF is an investment in long term corporate bonds, the Vanguard Long Term Corporate Bond ETF. And what I wanted to point were a few things. First, the dividend is much higher, 5.44, because we're taking a higher risk investment with a longer term. So the income looks really good. But over the past year, we've seen this investment lose value, 4%. So with a long-term bond ETF, you would still be in the positive, especially since that yield on dividends was 5.44. But we'd only be at collectively about a 1.4, 1.5% return on this investment, lower than the short-term bond ETF. It still outperforms the stock market. But I wanted to show this example to show how the recent rise in interest rates that we saw is making this investment less valuable. And that's what happens in a rising interest rate market. Long-term bonds lose value. So be aware of that. You can also buy individual bonds. And again, this is for the more seasoned veteran investor that's bought individual bonds. This gets quite technical, and you can make a few mistakes that could cost you some dollars. So either learn a lot when it comes to bonds, buying individual bonds, be really careful, or just buy an ETF. I really like ETFs in this category. But you can pick with individual bonds. One of the advantages is you can really pick the risk level and the term. So, for example, low risk would be lending money to the US government. That's pretty safe. And you can pick for how long do I want to lend the government money? I can lend the money to them for 30 years, for 9 months, for 3 years. So maybe I'm looking at a particular milestone or event in life that I want to preserve my capital and have that money ready for that particular date. I could also go up on the risk, meaning I'm going to lend money to riskier entities, companies that don't have quite the high rating. For example, triple B is not quite as good as the US government or triple A. Triple A is like Microsoft, Johnson and Johnson, but triple B isn't all that risky. And you can really get a better yield. For example, over 5 years, the overall yield on that bond would be about 7.3%. That looks pretty good, especially right now when the stock market's down so much. So just be careful when you go into bonds that you really study the ins and outs of how to buy bonds, and then do your homework on the particular investments. One bond that I bought recently was with Edison International. And this is the power company that I'm familiar with here in the California. And the the yield on the bond, the coupon rate is 6.25. So that looks pretty attractive. It's a 5-year term. So I'm lending them money for 5 years. And I expect that my money is going to perform at a rate of return a little over 6% for that 5 years. And again, I'm putting a portion of my portfolio there and just making sure that I'm taking lower risks by investing in bonds away from stocks so that I have that portion of my portfolio. They're performing at an adequate level and not having the downside that stocks are showing us in 2025. So that's an example of an individual stock. There's a lot to learn in this area, and an opportunity for you, especially as you get older, get good at this, because I think this is the difference between having an income yield of 5% versus 7%. That 2% over a 20-year span really makes a difference. It's a difference between going to Europe once a year for fun. It's a difference between buying a new car every 5 years versus every 10 years. It really is a substantial amount on a big portfolio, 2%. So study it up, and it's an opportunity to learn something new. And the final example I'll provide is gold. Gold has really worked for the past year. If you had invested a year ago, you'd be up 39% because a lot of investors recently have really bought into gold and have priced up this particular ETF. Gold is almost the inverse to stocks, especially when stocks are really struggling, which is what we've seen in 2025. So this investment may not be the best idea right now because gold prices are quite high, but it's something to consider in the future. Maybe when the stock market starts to really rally for an extended period, it's a good idea to maybe put some money into gold. I personally don't like gold. I just have never liked it as an investment. I invest in Bitcoin instead. And that has worked for me, but it does not have the same characteristics as gold. Gold truly is the hedge on the stock market, the hedge against when everything else is pretty much falling apart. Gold really stands up really tall, as it has done so for the last year. So maybe this is a consideration down the road, maybe 5 years from now, when times get much better and gold prices have really come down. The last 2 months have been a scary time, frankly, especially if maybe you're getting up there and you're about to retire and all of a sudden we have this type of market correction. I really can understand the uncertainty could drive a lot of anxiety and fear. And what I hope this video provides is just a few ideas on how to diversify into really safe assets that would really take a lot of that fear and anxiety off the table for you. Remember that stock investing is going to come with volatility. If you can't handle the volatility, maybe it's not the right activity for you. But when you remove, especially in my case, the next 5 years of my expenses are pretty much taken care of. So that's kind of off the table. No matter what happens, nothing changes for my family. When you remove that off the table, I can really concentrate on continuing to invest in the best way possible to grow my overall wealth. So having a portion of my portfolio just to preserve what I need for the next 5 years really gives me the freedom to do the best that I can to grow my portfolio the maximum amount over the next 10 years. So that's my video on wealth preservation. I hope you found it interesting. Love to hear your comments on how you preserve a portion of your portfolio in really safe assets and ideas that maybe can be an idea that another investor can take on to their benefit. Thanks for watching. Good luck with your investments.